$5 a gallon at the peak of the oil market boom earlier on this year that we saw in some states. So overall, very little in this report for the bulls to hang their hat on, with the exception of the diesel number. We did see ultra-low sulfur diesel. This is a cleaner burning type of diesel fuel. Those stocks down by 1.3 million barrels on the back of as demand increased, and really as a result of seasonal destocking factors there. So the emphasis still very pointedly on the downside, on the downtrend is intact, and a lot of traders saying that we could now possibly take out $50 a barrel if we see more weaker economic macros. Back to you now.
Sri, thank you so much. Well, I'll get you to stay right where you are. Let's bring in now Jonathan Kornfeld, Director of Asia Hudson Capital Energy. He just joins us now live on set. Well, good morning to you, Jonathan. Now, Sri was just mentioning $50 a barrel. I know Deutsche analysts have just brought out a report saying $40 a barrel. Where's this price going to go?
Well, it's really interesting. Even with the crude market coming off more than $90 in the last 4 months, there's really nothing bullish out there that can really make this market turn around, even for a day or two. Every day we're seeing the market push lower and lower and push new levels on the downside. Supply side, demand side, the inventories, the stock levels, and even investment flows. Everything is just pushing the market lower. We've seen hedge funds increase their short positions lately to the greatest they've been in almost 2 years now. So the market is certainly going towards the $50 level. There's really nothing that we're looking at right now that can really make it turn around. We've seen a lot of put buying. The $30 puts and the $40 puts are still very cheap, even with the enormous amount of buying coming in there. That enables investors and hedgers to get short from those levels. So people are certainly taking advantage of that. There's very little interest from consumers right now on the upside. Everything right now is just focused on this market going lower, and we don't see anything really that can kind of turn it around, even in the short term or the medium term.
Well, exactly, Jonathan. So let me ask you, how much of these trends that we're seeing is actually based on the financials, and how much is just focused on this very bearish trade?
Well, you know, the bearish segment of it has really a lot to do with both supply and demand. From the supply point of view, you see the OPEC members, they're still panicking. Even though they've already cut demand, they're going to cut demand some more. The emergency little gathering they're having at the end of November, they're really not going to do anything there other than issue a statement saying that they're probably going to cut more demand in December. From the demand point of view, we've seen U.S. crude oil demand drop 5% year on year, which is the lowest, the biggest drop we've seen since 1981. As Sri was saying earlier, with gasoline prices having come off as far as they have, there is still year-on-year drops in gasoline demand from 6 to 8%. So whether you're looking at crude oil demand or gasoline demand, there's no support there. And even if the market was to bounce off $50, it would be a technical bounce, and we'd probably rally up to maybe $51, $52, and then push through $50 again. So you better believe that this market is going to continue going lower.
Jonathan, it looks as if the U.S. auto industry bailout package isn't going to be passed. There's a lot of negative opinions there. If that is the case, then is that going to really add to the bearish sentiment in the oil market?
Well, I think what that's going to do is probably add to the bearish sentiment near term in terms of consumer demand and in terms of just people's opinions of the way they look at the market. Everyone right now is still very much afraid of losing their jobs, and if you see tens of thousands, even more layoffs because of the auto industry failing and restructuring, you're going to have the people today that are canceling their vacations, that aren't buying cars, that are just really afraid to reach into their pocket to spend money. That's just going to continue even more. So consumer demand on every front is going to continue to drop, and of course that's also very much going to impact the gasoline market, and it's going to impact airlines. You're going to see everything continue to go lower as a result of the auto industry continuing to struggle.
In terms of supportive factors for this market, as you mentioned, there are precious few. But if we do see a prolonged cold snap in the northern hemisphere this winter, that could boost demand for heating oil, possibly could be supportive for the entire complex.
You know, that's really just what you just said. That's about the only point out there that can really be supportive. And we did see heating oil rally just a little bit yesterday on those numbers. It was a bit of a surprise drawdown. Now, a lot of that has to do with, as you said, depleting of stocks. But there's also the concern out there that we're expecting a cold snap in the northeast of the U.S., which is a very large demand center for heating oil and distillates. So we could certainly see heating oil begin to rally, but that's not going to put a ton of support behind crude oil. And it's also interesting to note with the Saudi tanker that was hijacked just a couple days ago. If that news had come out 6 months ago, we probably would have seen crude rally $5 on that. As it happened, there was no result.
All right, Jonathan, that's all we've got time for. Thank you so much for joining us today.
Sure.
Jonathan Cornefeld, Director, Asia Hudson Capital Energy. Well, just ahead, we're going to cross over to Mumbai for a preview of the market action there. Which sector